Hi, Warriors. Mike, how are you? Mr. Capital Letters, Shahab, Bran, my trading warrior brother. Don't forget to include our sisters. And Ryan Littlestone,
Hey, mate.
who in the markets has big stones. So you could change your you could change your last name to Ryan Big Stones. So anyway, just
Don't
thought
start
it.
on that on a Tuesday morning.
All right. Anyway, good turnaround Tuesday, everybody. Had some risk off yesterday. Any view on currencies going into the Fed tomorrow, Ryan? Minor pullbacks here, more serious in commodity currencies than European views.
Yeah, I'm not sure what's shaking the tree this morning. It's a bit of a risk off look about things all round. Oil's off, commodities are off. Is it Fed? Is it in a month? It's always difficult this time when you got these big events. There's a little bit less liquidity. Everyone's, a lot of people sitting on their hands. We're getting some moves. Obviously, you got to take note of those. But levels by and large are holding. We've got a bit of a break in Aussie dollar. Said that yesterday. 65, 70 was a level. If that went, be careful if it became resistance, and that's what happened. And we're down at the big figure 7. So, lots of moves going on. But yeah, cables had a little look at the big figure 123. Euro dollar had a little look at 108. It's held. They both held. So in some pairs we got breaks. In other pairs, you test the big levels and they're holding for now.
Yeah. 102 is a big level, and Dixie, you could see, was rejected here. Kind of an important pivot. We got through it on this candle. So if we could close above it, I don't know if I'd want to be short dollars anymore for a while. Even though it was, you could have looked at this as two ways. God, the dollar can't get off the mat. Maybe it's got to crash to, clean everyone out and finish the move. Or the old saying is never sell sleeping market. And this is definitely the range for the whole month of January has been tight and non-eventful and quiet, almost like someone in a coma, an EKG of a comatose person. So, we'll see if this 102 means something. I think it does.
Yeah, the problem I've got is that you're sitting, 102 is a big level, obviously, but you're sitting at 102.08 and you got the Fed tomorrow. We could be at 104, we could be at 101.
Exactly.
You've always, if you're in a trade, if you've been long this and you got some margin, fine, you got something to play with. If you're wondering what to do here, it's a coin toss, even though it's a big level. But it doesn't mean you ignore it entirely. What I do with big levels, if we move away from it over the Fed, then you look at what happens if we come back to it after the Fed. So let's say we go to 101 after the Fed tomorrow because they've said something, not as hawkish as expected, and we're trading 101. Well, your 102 then potentially becomes a level again.
Yeah, to sell against probably.
After.
Yeah. Or if it rallies, you buy the pullback. If it extends its move, then you buy the pullback to 102.
Yeah, if you get a test and 102 holds, it's a level, and you say, right, well, I'm going to trade it this side now. It's the levels come back into play after you're over the risk event.
Okay, and talking about risk, we're still above the breakout level, even though it was a heck of a pullback yesterday from 4,100, which I think was 88.6 back from this high.
Yeah.
So, I still don't think I want to be short.
Play the ping pong, big figure ping pong.
And then we had a little bit of pressure in the gold. It's trying to bounce back here. In fact, this line right here is the throwover line from the wedge. So really to seal it, I think you need it under like 1894. And silver if it gives way under this low. There's a lot of confluence. Almost looks like it could be a magnet at 21 if it gets going to the downside and the dollar does break out. But that's where I'd buy miners and physical, and just, you know, with the Fed and BOE and ECB and then the NFP, you know, I'm not making any big bets anywhere. Yesterday I said,
you've got it nailed down, Dale. You've got the levels where you will trade. So
yeah,
it doesn't, to a certain aspect, it doesn't matter what the Fed does. But if you get your levels, that's when you're going to step in. You know, and that's the ideal thing to do. That's an expert trade.
And then on the crude, when I was negative up near the top, 77 was a target, and you know, here we are. So I think this is a top, and I'd sell rallies. It's a pretty big break. You've already had a $5, $6 break, so maybe rallies back to 79 or 80. I think we're going to, you know, here's your daily, you know, taking out all the moving averages unless it reverses. I think we're going for these lows. Look at, you know, look at the low back here. There was no divergence on it. You know, it just came out of the hole, and maybe this whole thing was just corrected and corrective, and we have one more flush, you know, maybe down towards 60. And then I'd back up the truck and buy oil shares. In fact, even oil shares, which led the market all last year, look heavy to me. Let's see where I had X. Here we go. Here's XLE. So it had a failing rally up here last week, and almost looks like it could do one of these from here.
It looks, hey guys,
still looks better than crude, but
it looks like a wave B there.
And the XLE.
Yeah, here it looks like a wave B rally, and then we can sell off for a wave C to the downside.
Yeah. Okay. So Greg has it labeled that way, and you know, maybe we have a quality or some kind of fib extension down here, and you buy oil shares. So that's kind of what's on my radar. Beans still, you know, trying to come out of here. Grain still trying to come out of here. So I still like the grain complex. See what happens there. To me, this whole pattern of beans looks incomplete. 1, 2. So that's why I think eventually we can make new highs in beans over 18.
Maybe got a big channel on that one, haven't you? You take the highs and the lows.
Yeah. So yeah, you mean like an uptrend, like that? Yeah. So it's So is K-Man back or not yet?
I am here. Good morning, Dale.
All right.
I hope you feel a little better, Dale.
I just added to my issues with sciatica in the last few days. So anyway, yeah, let's talk about US dollar yen.
Yes, sir.
You know, it still is pretty far away from breaking out. Looks to me like it could go either way, and yields look like they're trying to break out. The 10-year, where is it? But now we're down a couple, so we're back underneath this neckline. Tough call, yen and yields, isn't it?
It is, because now if you look at the yields coming down, dollar yen does exactly the same. So we're back on the train since. Well, I'm still catching up actually on stuff, but I've seen Suzuki's all of a sudden not too much in a hurry to change anything at the Bank of Japan's or any calls for the monetary policy framework and things. So we might be in really wait and see, and then let the US yields decide on what's going on with the dollar broadly speaking, and the dollar yen more in particular for now. Fact is, though, that the big yen buying seems to be over, because we, or at least temporarily, because we are, how shall I say, consolidating above 130 on the dollar yen, not hanging towards those 128, 127 lows.
I just want to make one comment on platinum. I never dreamed on this 3 drive to a top that we'd follow through, especially since there's a couple of people I respected that really like it. Platinum, Peter Goodburn is looking for outperformance in platinum, and Giles Coughlin likes platinum. So if you like platinum, it's getting pretty cheap here. It's still leading the way to the downside. So not ready yet, but I just wanted to point it out because a lot of people have been, you know, bullish platinum. Doesn't look ready to me. And that's it. I'm sorry to throw you off, but
no, I'm not a specialist on platinum, but I heard many times Stel and other people say, like, whenever something would be going, platinum could be leading the way. And yeah, it could be the case also why silver is so sluggish and not being able to hold the rallies despite better data again out of China overnight, and it can't hold it. We are on the 50, or at least we tested the 55 DMA there, and also the top end of the daily cloud for anyone who is watching in Chimoku clouds. Just
in
below,
what, silver?
In silver, just below
Okay.
$23.
Okay.
It's all there. We're still in the range, right?
Yeah.
But it doesn't look too optimistic right now, so I'm staying away. I might be missing a deep buy somewhere, but I think ahead of FOMC it's a bit too random to try and start to find the dips there. I don't know what can come out of FOMC tomorrow. It can go either way. I guess we'll talk about FOMC tomorrow.
Yeah, I know one thing though, and you guys could verify. You're all pros, and a lot of people talking about 2250 in silver for a month now, as you know, where this correction could go to. And when there's unanimous opinion about a number, what I've seen over the years is it either never achieves it, or it becomes pretty unimportant, cuts right through it like a hot knife through butter. So the 2250 level is here, and I'm in the camp where I think it's going to get cheaper than 2250. And I didn't do the fibs, but I bet there's a fib around $21 there. So
yeah, there is one. The 50% of the move from September around $17.5 to the latest highs is around 21.05.
okay, confluence.
And
so
we
have silver cased, huh?
I have a little bit going on in the low 22s as well.
Okay.
But I really want to wait what's coming out of the FOMC. And
yeah,
I'm not in a hurry on that one.
Yeah, you don't have to.
No.
You know, you just proved you could be away from the markets and they'll be here when you come back.
Oh yeah, definitely.
You know, I tell people, you know, some guy wrote me, goes, Dale, I'm having a hard time. I'm down 2%. I'm really, you know, off. I'm off. And I said, well, you know, sometimes taking a week off can help.
Yeah.
And I guarantee you that the markets will be here when you get back.
Yeah.
So he only took a few days off and it cleared his head. So, you know, keep that in mind. It's okay to just go ahead.
The mistake a lot of people make is to try, if they are on a bad run, to try and make it all back in a day, and it's never working. The best thing is actually to take a couple of days off or more, and then the markets will still be there. As long as there's money flowing in this world, the markets will be there.
Yeah. Okay. Stel, how are you today?
I'm good, thank you. So
Good.
silver, we've been talking about the levels for ages, right?
Yeah, well, yeah.
You said some people are looking at 2250. I think it's the low 2190 to 2220 is the area I'm interested in.
Okay.
And on the other hand, it's 2450. So we're bang in the middle.
Yeah.
And there is daily volatility, obviously, and the head of the Fed tomorrow there's there will be volatility, position squaring. Mark Chandler wrote something about it this morning on we put it on Trader Summit, and he was talking about position squaring and month-end flows, etc. So a bit of noise, I think, ahead of the Fed tomorrow, and it is a pretty binary event. If it's not at 25, I doubt they're going to do 0 or 50. If it's not at 25, there's going to be hell in the markets, I think. But the big question also always remains, they do 25, what do they tell us about going forward? And again, in that case, the market's pretty clear, 25 tomorrow and another 25, and we're done. And then, of course, after that, the market in like 9 months' time is looking at cuts, which is a different story. Looking that far ahead, it's who knows what's going to happen next month, let alone in 9 months' time from now. But the big question is, does Jay Powell want to shake things up a bit? Does he want to to cause the markets to go in a little bit of a spin, and he will do that obviously by being hawkish. There is a chance he's going to do that, but I just don't see why he would want to do that. The economy, the U.S. economy, apart from jobs, which again, that too is debatable, but apart from jobs which are still printing okay, everything else seems to be turning. And it is clear, I think, that we are going to be entering a period of economic underperformance, let's say. I'm not saying necessarily a recession, but it's not going to be great, and layoffs coming, and the cost of living is increasing. All that factors into a more difficult environment for the average person. So given that, and given that the markets are still relatively okay, right? The S&P is at 4,000-ish, down from 4,800 at the highs. I mean, it's not a huge move, and it's been very orderly. Sorry. So it's been a very orderly move. So why would Powell want to disturb that and cause the markets to crash? I mean, theoretically, they are starting to get what they wanted, which is a soft landing. So as long as markets don't go crazy and inflation continues to drop, which I think it will, they're going to be relatively happy. So I don't see a reason why he will want to be too hawkish, given that inflation has started to drop. This is what they want. If inflation was sticky, and remember, he has been hawkish while inflation was sticky and rising. Now it's dropping. So, I don't see the reason why he should go out and be hawkish and disturb the markets and kind of shake them up, because he's getting the result slowly, but he's getting the result he wants. I don't know what Blake thinks.
Well, I was going to, hey, good morning, everybody.
Good morning, Blake.
Good morning. I was, just listening to you talk about inflation. What's up with the, now you guys were around yesterday and we didn't really talk about this. Maybe we did, and I was half asleep. It was a Monday morning, so you have to excuse, Dale and I at this time of the morning, we're usually, right, Dale, we're usually kind of half asleep as we.
I hear the owls.
Yeah, I mean, seriously, we got owls go, woo, woo, woo,
yeah,
right next to us. I got them too. By the way, those are big time predators in our neighborhood. But I just wanted to say that the Spanish CPI yesterday was bonkers strong. I mean, I know everybody's thinking inflation is going to continue to slide, but there's a few people out there that don't. And I think that's the Fed's biggest fear, right? Is you think, like, Dale, let's go back and let's, you've had conversations with guys and gals that have been around in the inflation era that we had in the late 70s, right? And yeah. I mean, inflation didn't just drop. No. It took years, and you had a lot of like fits and starts of it pulling back. I mean, right now it seems there on the surface that it seems like everything's great and inflation is going to just slide right back below the Fed's 2% inflation target, but I'm not so sure that it will. And I think that's the big risk that we have, right?
I just wanted to point out one thing on the S&P, guys, and then I want to turn it over to you, Blake. When Matt Weller was here, he was talking about how we have an inside month in the S&Ps, which he's construing as bullish, that we'll have follow through. let me just go back a little bit and show this example of an inside month. And what we did was start higher and ended up reversing on the month. And the same kind of scenario could happen if we start off higher, take out this month's high, maybe trade up towards 42, 43, and then start becoming unchanged on the month because today's the last day. And the most bearish thing it could do is take out this monthly high and then take out the monthly low. That would be, you know, very serious damage. So, you know, inside months to me are exactly what they say they are. They're neutral. And what happens the month after is really the key. Just like this, you could have said, well, this is bullish because, you know, we have an inside month, but it ended up being a reversal month to the downside on the next month. So just something to put on in your thinking cap for sometime in February.
You know, my old friend Chris Bayer, he used to call that his Brazil 61. Some of you.
Oh yeah, I remember him.
Yeah, he used to call that the Oreo formation, Oreo cookie formation.
Did he dunk
like
it
10
in
years
milk
ago?
or? Yeah,
and I mean, it's always kind of stuck with me, but yeah, I hear what you're saying there.
Yeah.
All right, well,
I love Oreos.
Yeah, I'll take over the charts here,
Right,
and let's get over to look. Well, what do you guys think? I mean, look, are we past this inflation stuff? I mean, you know, what's going on? What do you guys think about that?
Peak inflation or not?
Yeah, I mean, what's the, like I said, I was looking through the data, and I know, you know, and this is on the ForexAnalytix platform, and you know, Spanish inflation came in at 5.8% yesterday over 4.9 expectations.
Yeah.
So, and the previous was at 5.7. Now, you know, you might live in Spain and say, well, you know, I'll tell you exactly what the issue. Jane's jumping in saying that they've changed a method, but still, you know, I'm not. What's that?
Spain has led the way in. They were probably the first, I think, that saw inflation coming off the peak. So they may be leading or showing a lead on the others. But France did the same. They were expected to rise again, and inflation went up this month.
Okay. Yeah. So again, you know, these I think are issues longer term that that the Fed's dealing with, and everybody, you know, as traders, we're seeing, you know, what is happening right in front of us, and then we automatically, you know, we'll shift gears, like you know some person on ADHD that just can't really focus on one thing, you know, longer term. They're just looking at what's happening near term, and right now I think the trends are that we are still in an inflationary environment. I know it's coming off, but you know, it hasn't reached the Fed's target, and I think that's going to be the overarching theme this week that we hear from the Fed is they're going to be strong. I mean, they're going to continue to be hawkish. But you know, K-Man, we missed you yesterday, and it's nice to have you back today. What are your thoughts regarding, because we had this conversation yesterday and wanted to kind of expand on it a little bit. What are your thoughts on the Fed going into tomorrow, and what's their messaging going to be, and how do they get across the message? If it is to be hawkish, how are they going to get their message to be hawkish and get it across to the market? Because the market has not really believed the Fed, you know, as of right now.
Well, I mean, the base case is 25 BPs. I think there may be like some really small percentage chance they do 50, but I wouldn't think so. For me, the kicker will be what they say about the financial conditions, and if they make any twists to QT.
Yeah.
What about MBS? That could be the kicker for the yield environment tomorrow, and per correlation the dollar. I'm very open-minded going into the FOMC tomorrow, I must say. I have very little running, and I will have very little running apart from a few crosses that I have on, but yeah, it's really an open play. But we have to note that going into the FOMC, the big levels on the top side, euro, dollar, cable, Aussie, and a few others. I think Kiwi was on an important level as well to close the week last week, and they are holding on the top side. So we know where the danger levels are, and that's the important message here, I think, going into the FOMC. Personally, I think they will try to be a little hawkish just to get the market away from the conviction that they will start to lower yields this year. So I think there may be a bit of a fight back here. So I'd say in percentage-wise, if 50-50 is the neutral, I'd go 60-40 for perhaps tomorrow. After the initial up and down algo swings, the dollar might tend to be a bit stronger, but it's only a 60-40 opinion.
All right. Well, thank you very much, K-Man, for your opinion, your non-60-40 opinion there. I want to say that you know, that the Aussie dollar was our chart of the day yesterday. Most of us have been on the short side of the Aussie for the last week or whatever. I had made an adjustment for the patterns in play because, you know, this, like K-Man just pointed out, you really know where your risk is. Like in the Aussie, the risk is above these highs. The Kiwi, the risk is above these highs. The Euro, the risk is above, you know, this major underside of this trend line. And the whole reason why many of us have been, you know, been on the short side of the Euro for the last week and a half is, you know, being short because of that. And I think it's pretty well defined. I mean, if you're playing the dollar on the long side, you know where you're wrong. If you're going to play the dollar on the short side, you kind of know where you're going to be adding. The one thing I do want to point out, I think, as we head into the next couple of days, which are very important, is that the dollar bounce has been very shallow. Yeah, it has really been very shallow. I mean, yeah, we just kind of jumped out of this wedge, and you know, as we were expecting. But if you look at the like long-term trends that have been broken, you know, this goes back to back here to 2021. We're still below that trend line, and that means that the market really needs convincing. And I know we've discussed this through the week ahead videos and whatnot, but you know, we need a break back above 103 on the dollar index to convincingly tell the market that the dollar is ready to squeeze, and then that's going to be a move against risk on, and the S&P, as you all know, is really still in breakout territory. I know it slid a little bit since Friday, giving back Friday's gains, but we're still in that, you know, that technically that breakout territory that everybody and their mothers, brothers, uncles, sisters, monkey has identified in the markets. We're still in breakout territory, so we got to keep that in mind. We've got Canadian GDP coming up in a few minutes. K-Man has said in the chat room that he'd believe that there really wasn't going to be a mover. I don't disagree. I do think the dollar Canadian is like pretty pivotal right here, which gives us a, you know, Gartley bearish setup, or a bullish setup would be a, you know, move down here. And it's funny because it actually goes either way. You could actually, you know, kind of play it in, you know, no matter what your argument is, where the loony's going, you can build a technical case against with it and against it, which is interesting. Maybe that spells exactly the reason why I'm not really focused on the dollar Canadian at this moment. But do you guys have any opinions about the Canadian GDP coming out in a minute? Anybody? Bueller? Nope. Ryan?
Any thoughts on the GDP?
Thoughts before I'm actually, what I'm doing is just adjusting the charts here. But yeah, any opinions going in to this?
More bats on that chart than the Batman film.
There are bats and Gartleys and all sorts of things. That's right. Here's your data flash. Go ahead.
Everyone's throwing out Q4 stuff, and we're still doing November stuff for Canada. So,
well, that's a great observation. That's good. That's funny. All right, so we have Canadian GDP coming out just in literally a few seconds. You'll see it. This is the data flash that's included with your ForexAnalytix platform. And then after that, oh wow, strong.
In line.
Well, in line.
In line.
Yeah. Oh, look at the euros getting a little bit of a wow. What happened to the dollar yen? Smash-oled there.
What?
Oops. What? ECI. That why we have the ECI that just came out. Employment cost index 1.0 versus 1.1 or
yeah, tad lower than the prior one. And
it is an employment cost
wages
index
as
is
well
a
coming
factor
up.
that the Fed looks at going into for inflation. So wow.
I don't think I've ever seen that number move the market like this.
It's I guess everybody's super sensitive to inflation right now,
Yep,
right?
that shows it. That shows it.
That showed a little tick down in inflationary pressures. And so if you had any US dollar positions, you're probably looking at them right now going, oh, fudgesicle.
Yeah, 10-year moving like a couple of BPs straight away on the back of it. So.
Yeah, I mean that was a pretty big one. Yeah,
and the 2 years as well is 3 BPs lower in the immediate aftermath.
Yeah. All right, guys. Well, be careful with that ECI number that just came out. Here's the thing. I want to make sure I mention this. Yeah, you may have missed your opportunity to get ForexAnalytix at like 40% off. But we still have a 25% discount, which is our normal discount if you want to do an annual subscription. But look, if you want to take advantage of ForexAnalytix and get it included with something, check out the Trader Funding Program. We just had, let me get his first name. I'm not going to tell you first and last name. I want to say congratulations to Elian and Kareem. Two of you have reached their profit targets, and that means they have now qualified to trade ForexAnalytix Capital. So there you go. And I'm not going to tell you what account values that they have qualified for, but we had 2 people reach their profit target today, and we'll be trading our live money and not taking any risk and receiving 75% of the returns.
Congratulations, so Ben and Kareem.
Yeah. So if you want to learn a little bit about this, make sure you click on the video on the Trader Funding Program. I'm going to put the link right in our chat box. Dale, I'm going to pass it over to you, buddy. And by the way, we do have a couple videos coming out about how I passed the Trader Funding Program, and we have Nick of Jupiter. His video will be coming out. Unfortunately, we've been put. Our timeline has been pushed back a little bit because we have some of our staff is unwell and is trying to get on the road to recovery. So after that, we'll have those videos out. Okay.
Everyone keep a good thought for Steve Foggy for him to get better and back in the saddle.
Yes, thank you.
Steve.
Okay. Thank you, team. You guys are the best in the business. And this is the best webinar on the net.
Thanks, Coach. Have fun with Rohit. He's a great technician. Love having him here.
Yeah. Hi, Rohit. Welcome back.
Hi, Dale.
Welcome back, Rohit. Great to have you.
Yeah, pleasure to be back.
Yeah. So, what's top of mind in 2023 as we wind up the first month, which was a pretty good risk-on month for the S&Ps out of the gate. Had a very good January. Why don't you share your screen and let's see what kind of wave counts that you're considering here going into a new month.
So a lot of game changers happening here. I'm being forced to consider what you always ask me for, which is alternate wave counts. So I've actually been considering a lot of alternates in the last month based on what is changing continuously. We had, and one of the things which drove me to change my equities view, we do need some additional confirmations to come through, is the extreme negative sentiment, both in the Indian and US markets. The put call ratio based on the volume of puts traded by the volume of calls traded reached an extreme number. And that became one of the primary reasons. So I'll just showcase that chart. Here it is. This is, of course, the S&P. This is a history of all the high readings, and each one has been followed by multi-month advances in the market, if not multi-week. Some of them have lasted for a short period, but many of them have lasted for a much longer period. And so that sort of pushes you back to think whether something different could really be happening. I mean, for a year we've tried to think about whether we've actually popped this bubble in growth stocks and so on.
Yeah.
But this kind of extreme sentiment should have occurred either at a lasting bottom, or if this is a continuation of the bear market, we shouldn't have been bouncing right back above the 40-month average, which we have done, which didn't happen in the last two bear markets. And so that's sort of at a tricky point where it means that there is a chance for some reason, what will change, we'll see that we could actually start a rally that can retest, not just end up being a retracement, but even retest the highs. And that is a risk that I'm trying to consider one step at a time.
Let me ask you this. Is there a count
Yes.
now that we are an alternate count
Yes.
that could take the S&Ps back to 4,300 or take out that high marginally and then fail from there? I think it's called an X wave if that happens.
So I'll show you both the counts. This is the first chart. This is, of course, the NASDAQ. This is where the weekly RMI is basically I call it the Rohit momentum indicator. It's a smooth rate of change indicator with some more indicators put together. Now, essentially, what it's showing is that we've piercing the this is slightly dated chart. We are piercing the 20-week average, heading towards the 40-week. I think we've crossed that as well last week. And in terms of wave count, so initially I was trying to think, that this entire fall is essentially a leading diagonal, a series of 5, 3, 5, 3, 5, but it just went on. And as it went on, we actually forced to think, that maybe it's not that. The alternate, as you ask, is likely to be a more complex pattern. So here I'm using the S&P to show a more complex pattern where everything is overlapped, which means instead of ending up as a 1, 2, 3, 4, 5, we actually ended up with W, X, Y, X, and Z, which sort of means we may have completed Z. And if it is an expanding triangle, then this is typically a third and a fourth wave. We have broken out of this falling trend line right now. We've almost come back to this previous high. So there's a good case for this to be an initial. First, I thought, okay, if it's counter trend, it'll be ABC, some larger X. But what if it ends up being a larger, fifth wave of something which is pending, and then only we'll actually see things roll over. Now, a lot of this will depend on how the economic factors also kick in. So this is how the alternate would look like. Okay. That the triangular structure is just a fourth, and you have a fifth pending on the upside. So this is what I'm trying to think. The bearish case is, of course, you just retrace 61% of the entire fall and then lose momentum, and you go into a recession. But if that doesn't happen, if you end up with a soft landing, things turn easy and you can actually generate a fifth wave, then it might
melt up. It'd be a melt up.
And
6,000. Yeah.
Yes.
Okay. So I'm hearing more melt up talk, and they've canceled recession forecasts in Europe. They're beginning. All right, I'm just saying they canceled it. I mean, it's not like they had a trade on. How do you cancel a forecast? You change your forecast, and they're now everyone is in the soft landing camp. Many, the majority, not everyone, majority now coming to the soft landing scenario in the US.
Yeah. So this is a chart of the FTSE, since you mentioned Europe.
Yeah. It made a new high, all-time high, right?
Exactly.
All right.
And so I ended up drawing a channel and considering that what if this is again same thing, fifth wave in progress.
Yeah.
And if that is true, then we've sort of delayed some of the eventualities out here. So at least we bought ourselves some time, if nothing else.
Okay. Do you have any kind of, I think the most contrarian trade, especially now that Meltup's back on the table, is long volatility, because it didn't work all last year, although we had 25, 30% declines. It never really worked. We really never had a capitulation move with vol getting above 35. People are now saying they're not going to hedge anymore. It's a waste of money. And, that the VIX is broken. And even during the decline, the people who made money were shorting volatility. I was wondering if you had any kind of count or any kind of view on the VIX, which has gapped up this week. I'm not saying this is the low, but I certainly wouldn't be short volatility here. And considering call options going out to June, what's your thought on the VIX here?
So you can't really do a wave count on the VIX because it's never trending in a particular direction. What you can do is look at certain ranges, support, resistance. Does it stay above 20? Does it go below 20? Because when it goes below 20, you get trending bullish phases. My hope in the bearish case was that it wouldn't fall below this line, because that is exactly what happened in 2009. So when I looked back at this scenario, even 2020, if you had a base support line that eventually led to this big wall explosion. The same thing happened even in 2009 bear market, where at this point, once we had this base, we didn't go below it. So which is why I'm a little surprised that we have actually gone below it. And so I'm not really counting on a big spike.
But we're back above it now. Maybe that was a false breakdown. Now, as of today, we're back above it, aren't we?
Very, very tight. So it's like, just kissing there. But what happens?
Isn't that nice? The VIX will kiss you before it takes away your money. So nice. Okay.
But sometimes if I just take periods which are bullish, what ends up happening is that you do get wall spikes, but they don't end up being big, So there's just small short-term panics, and then the bull market goes on. So you have many of these small spikes. So I can't rule out you get a spike here, but now how do I really guess that you're going to get something which is large? So for that, we will really look for additional confirmation from the S&P or the Dow itself, I think, or the dollar itself. I mean, one of those things. We have, of course, been watching many moving parts. You have the bond market, you have the dollar, you have the equities themselves. And the dollar, which was the other big one itself, has, gone right back below what I was calling. So I think a year or two back when we were talking, I was saying that, we are in a dollar bear market. And I thought this last dollar bear market was 7 years. And I thought this would go on for 7 years, maybe much lower. That didn't happen. So 2020, 21 ended up being the end of that phase. So within 4 years, all the boom we saw in commodities appears to have ended. But here's a massive long-term intermarket divergence. This big spike in the dollar hasn't really led to a crash in commodities, whether it's oil, whether it's copper, whether it's gold and silver. Yes, there's been a correction, but it's not essentially a crash. And I think that's telling us something, which is sort of why I've changed my dollar index wave count. You were questioning me last time that what if it falls below 102 or 103, which is the breakout point. And now that it has, then what does it really mean? It means that the dollar spike ended up just being the false, breakout, at least for the time being, till we have fresh evidence on this. So what I've tried to
bearish the dollar now.
Bearish the dollar for the time being. So I tried to think, just like 1990, you had this extended bottoming phase which ended somewhere here. Maybe this is an extended bottoming phase here up to here, and then you can have 5 waves from there. And if this is complete and you do a 61% retracement, you will retest the 89.90 mark. So this can be a prolonged, nice ABC pullback before you resume any further dollar bull market. So it's just one of the possibilities.
Okay. So gold had a big run and silver had a big run with the weak dollar. I believe last time we talked, you weren't as convinced about the bull case. Are you now?
I am more convinced now. So I was waiting for maybe a potential X and Z over here. And I thought maybe if that happens, we will go back to a 61% retracement mark. In the interim, this current rally has been strong enough to push my momentum indicators, say on a higher time frame. So I'll just show you on a monthly time frame to buy crossover. Okay, so this is the monthly close coming in. I think for the current month, it's crossing over. It's not complete yet, but I think it will happen. I mean, today is the close, right? So today is 31st. Yeah. So I think you'll most probably get a confirmation that I have a buy signal on the monthly momentum cycles, where we've taken support, I think, at this lower band as well. Very similar to what we did in 2018. So I'm sensing that probably the fourth wave, which is, if I think of this as 1 and 2 and think of this as 3 and 4, then fourth wave is probably complete here. Then we are starting the fifth of a larger degree. So this is what I'm starting to think about.
Okay, shorter term, where you've peaked short term under 1950. Do you have any levels based upon your longer term count that would be an area to look to enter the long side of gold if we get a correction?
So very short term setup is to watch the 20-day, okay, because we did hold the 20-day average here and take support. Are we going to continue to do that and extend? Or if we break this, so I'll just give out that level. If we break this, then we can come down. I'm not sure whether that will happen. 1900 is the support. If you break 19,
we got down to 1902 today.
So if we break 1900, then we may get lucky of getting 1860. But it has to close below 1900. If it doesn't close below 1900, the possibility is that it may just take support there and continue to extend on the upside.
Okay. All right. And oil, which is, I think the last week has been pretty negative. Is there a shot for that $70 level to be violated with your work?
Yes, so I am looking at buying the dips in oil. I think it has started what is slowly looking like a trend reversal. And the question is, at what point should we make the next entry? I think one of the retracements, the 50% retracement and 20-day would come somewhere close to $83. 61% could be $82. So we'll keep those two levels in mind. Give it a couple of days, let it stabilize, and show us.
We're under 82. We've gone to 77 on WTI, if that's what you're showing.
This is I'm showing Brent.
Oh, I see. Okay.
The reason I've started using a Brent chart is because it doesn't have that big spike down to $7, which we can.
You mean the negative print?
Negative print. And so it gives me a very clear channel and wave count. So when I'm looking at this big picture, I'm able to see that, okay, we got a 1, 2, 3, 4, and 5. And after that, we've been in a corrective mode. And then from there, I've done W, X, Y, X, and Z. So this Z sort of completes the correction. I would have really liked if we touched the fourth wave of, previous low, which was around $65. I was actually waiting for that. But since
it still happen, couldn't it?
Yeah, it can still happen, but since we took support on this line,
I
have backed off from that for the time being till it actually shows up.
Well, you know what? The most important thing I gleaned from it, besides, not caring about the short term, on your count, that whole rally was only 1.
Yes, that is right.
Okay, and this whole thing is 2.
Yes.
And the third wave is always the money wave that could be a fib extension of 1. So that projects, gosh, what, 180, 200? If we have something like that from 7 to 150 and then 1.618.
If wave 3 is even equal to wave 1, it's hundreds of dollars higher.
Oh my goodness.
Because it's in percentage terms, right? A percentile scale will be very high. If I do it point terms, definitely it won't be that big. But if I go with a log scale, then it's pointing like way off.
Yeah.
So this was sort of what I started out with when I was thinking the dollar is bearish, that the commodity cycle would have changed permanently, which we can see in the 5-wave advance in oil. We can see it as a 5-wave advance in copper. Copper is in fact so interesting that it only retraced exactly 61% of the entire advance that it made in 2020-21. So it's been a pretty exact retracement. If we take the entire run up, exactly 61% taken, and there the daily sentiment index here I've put it was 7%, which means there are only 7% of traders bullish from where it's moved up. Now the only thing which has happened is it's moved up to the 61% retracement of the fall, and so this is where the bulls and bears will have a little fight.
But that measures way over 5.
Yeah,
that measures what, $7?
In terms of the third wave,
yeah,
it will measure well above $7. Yes.
Yeah.
So I think that the entire commodity complex was waiting for that. I mean, the risk was that if the dollar kept going up, then most commodity prices would have retraced more than 61%, gone to an 80% retracement or something. But it looks like all of that is backed off. Yeah. So this is coming to around $7.8. Yeah.
Okay. All right. I can't think of anything. How about yields? You have a view on the bonds or notes?
So for the time being, when we think, so I think everything is going to be based on the speed at which things happen. If I look at the 10-year, I have just written a note today. Right now, it seems to be building up to move higher. Now, whether I should take this as A or I should take it as 1, this is just the initial wave up. We've had the first rally. We're sort of consolidating, I think, A, B, C, some kind of consolidation. I do think it will move up in 3. This is, of course, the bond price, not the yield. Okay. So if it moves up, which means yields go down.
Right.
Now, we can argue at what point will rising commodity prices become a yield problem. But, if you look at the last commodity cycle, 2002 to 2010, it wasn't really an interest rate problem. So the real reason behind the big inflation this time may be very, very different. If we can get prices to move at a slow pace, I think that's going to be the real objective here, because, higher prices are sort of been considered the solution since they started talking about MMT to solving the debt problem. If you don't want to default, you have to get inflation. The problem is if you get too much inflation or too fast. So the solution is to get it slow. If you can get commodity prices moving up slowly, then I don't think we get a major bond market shock.
Well, so, your wave count in Brent certainly argues against that.
I know. So what I'm trying to say though is that probably that has to happen much more slowly. We start thinking of it going up hundreds of dollars and will it happen in 1 year or will it happen in 10 years? I think that's where the catch is going to be.
Okay. All right. Well, eye-opening stuff today, Rohit. So really appreciate your views. I consider your work. I've seen some Twitter comments. Just, ignore those. I consider your work elite, and I know Blake does, and our whole crew. We pay attention when you speak and show your pictures.
Thanks a lot. So I'll just highlight how this is playing out in the Indian context. There's been a lot of controversy. I'm sure everyone's heard about what is going on. So what was happening before this controversy showed up is that just like we saw the very high put call ratio readings for the US equities, the same readings are also there for the Indian equities. The only thing is Indian equities, they did bottom at the, along with the world in probably late part of December, but they didn't rally. For some reason, they just couldn't get above, the Nifty couldn't get above 18,200. It made multiple bottoms at around 17,780, 17,800. And then the most recent news around the Adani Group, which is one of the large conglomerates, came out and sort of crushed the stock. But it looks like it was all around their IPO where they're raising additional money, which went through today, 100% money. They managed to get institutions to fund them. So retail investors stayed away out of fear. but they got institutional support, and so the IPO didn't fail despite all the news flow. So that's the good news. Tomorrow we've of course got the union budget, which is an annual event. And the history of this union budgets in India is that whenever markets have, there's a lot of sentiment. People usually expect some kind of reforms or additional money spending by the government. And markets tend to reverse around that time period. It's like almost with a 90% repeat process, which means that if markets are falling ahead of the budget, they often tend to bottom out because some of the worst is already discounted and then they turn up. Sometimes when markets head right up into the budget because they've been rallying for the last few months, then they tend to peak out over there because most of the sentiment is discounted and things roll over. So it's just sort of been the history at least 80% of the time. So I think given this extreme sentiment, and now that sentiment has got even worse thanks to the Adani fiasco, which is now behind us today because the FPO is fully subscribed. The setup is for a complete reversal starting with the budget tomorrow, which means I think the Nifty shakeout in terms of the Nifty index is done, and we should start heading higher. So I'll just open the Nifty chart. The Nifty chart's been pretty ahead, I think, of global markets because it moved to an all-time high in November, December. It had a very similar complex correction like what I'm trying to do on the S&P, W, X, Y, X, Z, and expanding triangle, already complete at the bottom of June. And then it made its first attempt to break out of that in August and then finally did so in October. Now this most recent pullback is coming back and testing exactly this line which it broke past. Okay. So we also have some gap supports which I've marked on this chart.
All right.
So my sense is this panic is done. We can see the panic volumes at the bottom. So it's kind of a selling climax.
Yeah.
And we will be starting a third wave of the ongoing bull run. So I'll just take a blank chart to sort of put a projection of what that means. Which means again, this triangular structure most probably is a fourth wave of some degree without really getting into what degree. What I want to think of is this is wave 1 and wave 2. And what we are looking at as a minimum is a third wave where we start a rally from here towards around 21,600 in the coming weeks to months.
All right. So bullish India. Buy panics. Buy when there's blood on the street.
Absolutely. I said that on television and they said you're sounding like a fundamental analyst.
Oh, yeah. Well, throw a few drops of blood on your chart and then it'd be technical. So anyway, I think we all have left some blood on our charts. So anyway, I love that expression and really love your work. Thank you so much, Rohit, for being here today and sharing your work with our community and giving us some nice macro things to use in our narrative. Appreciate it.
Thanks. Welcome.
Okay, so my trading warrior brother, Rohit Svrasta. How was that?
Good. Close.
Good? Not bad, huh?
No, it's close.
All right, everyone. Thanks, Rohit. And you could join the team in 17 minutes for the morning edge. And don't just count your rupees, count your blessings. See everyone tomorrow. Adios. You're welcome.